Okay, so let's continue from where we left. But today, my main focus area we have to cover ias7. So let's just round up. I think there is one more item that we need to add to the last issue we're looking at. So remember, we said if the firm does not have control, then that's an associate. So if you have significant influence, that makes that other firm our associate. So for our associate, we are not going to consolidate. So you're likely going to get a question with both a subsidiary and an associate. So for the associate, we don't touch the amounts. That's in terms of consolidation. You're not going to be adding the amounts for the associate because we consolidate the books of the parent and subsidiary, not the associate. But for the associate in the income statement, you just show one figure, that is the profit earned from the associate. Then what about in the statement of financial position? So in the statement of financial position, the associate is equity accounted. So, oh, what happened there? So the statement of financial position. So in the statement of financial position, the investment in associate is equity accounted. So the investment in associate is equity accounted. So what do I mean by the investment in associate is equity accounted? So there is the equity accounting method, which let me give you the layout. So for the equity accounting, the cost of the investment it comprises of. So under the equity accounting method, remember an investment in associate is just going to be shown under intangible assets as an investment. So it's actually an intangible asset that you put my assets in your business. But this one is an intangible asset. So we are going to record the cost, that is the price we paid to buy the shares. So let's assume we bought the shares at 160,000. That is the cost. So we bought 25% shares. So we bought 25% shares at 160,000. That's the cost I'm talking about, the price you paid to acquire the shares. Then the subsidiary is going to make a profit during the year after acquisition. So for the profit that has been made after acquisition, what we are going to include in the cost of the investment is the share of post-acquisition profit for the year. So for the associate, if let's say we bought 25%, we bought 25% shares in the associate. And during the year after we had bought the shares, the associate made a profit of, let's say they made a profit of 20,000. So you would say 25% of the 20,000. So we're not going to add all the profit, we just take our share. So the share of the profit increases the value of our investment. So the share of the profit, if we are using the equity accounting method, that share of the profit is going to be increasing the value of our investment. Then if you receive a dividend, the dividend received reduce your profit. So dividend received, if let's say you received a dividend during the year of 1,000, because the dividend is being taken out of the profit. So it means the amount you are going to report as being the value of your investment in associate is you add the profit made, you less the dividends we received. So this would be the value of the associate in the statement of financial position. So this is the equity accounting method. So under the equity accounting method, the equity accounting method, the dividend received reduces the value of the associate, whereas the dividend paid, so whereas the profit made, profit from associate increases the investment. So to get the closing value of the investment, you are adding the profit from associate, you less the dividend received. Now, let's move, I think the rest of the stuff you can practice and you can read. Then let's move on to ias7 so that we cover much ground. ias7, that's the cash flow statement. So ias7, this one, that's cash flow statement. The cash flow statement. So under this standard, what is it that we are doing? We are tracing the movement of cash in the business. So under the standard ias7, we are tracing the movement of cash in the business. The key assumption is when money is coming into the business, it comes or it is financed by three activities. And also when you make payments, there are three activities that are going to result in us making payments. So the cash flow statements, this traces the movement of cash in and out of the business. It traces the movement of cash in and out of the business. So the standard, or we can say under ias7, there are three activities that either result in us receiving or paying money. So money is either received or paid as a result of three activities. Which are these three activities? The first activity is we have the operations. So we have the operating activities. So the operating activities of the business, these are the day-to-day activities that the business is conducting. So the operating activities, these are the daily activities of the business. So in the business, on a daily basis, we can receive money from ourselves, we can pay for expenses. So that is money that is being received or paid as a result of operating activities. So the operating activities, these are the regular expenditure of the business, or we can say these are the daily expenses of the business. So money can either be received or paid as a result of operating activities. Besides the operating activity, another thing that can result in money being received or paid is the investing activities. Investing activities. So investing activities, the business makes a number of investments. The investments can be investment in fixed assets. So this is where we look at the money that we have received through the disposal of assets, or the money that we have paid to acquire assets. So this comprises of of the money received to acquire, received on disposal of non-current assets, disposal of PPE, or so this comprises of the money received on disposal of PPE or paid to acquire the PPE. So we have cash flow that can be generated from operating activities, cash flow that can be generated from investing activities. We also have cash flow which can be generated from financing activities. So if we are looking at the financing activities of the business, the financing activities of the business, this is money that we have either received or paid as a result of shares and loans. So the financing activities, these are the sources of finance. We can get money through the shares, you can get money through loans. So we can either receive money or we can make a repayment if it is a loan, or we can make a repayment if it is redemption of shares. So this is looking at the money received or paid. Let's look at the money received or paid through the issue of shares or repayment of loans. So those are the financing activities. So if you are given money at the start of the period, you are an accountant at the start of the period, you're given 500,000. Then at the end of the period, you are asked, how much do we have in our account? And you tell them, in our account, we are only left with 10,000. The next question is, where did the money go? Because we started with a lot of money. How come you're telling us you're only left with 10,000? So we are going to trace the movement of cash. Then they can ask you, the business has been operating. The business has been operating. So does it mean that maybe the shareholders asking that we're not there in the organization? Does it mean that the business has not been operating? Because the business has been operating. So even if we set the 500,000 that we started with aside, does it mean the business did not generate any cash during the year? So the operating activities, we then actually find out, no, the operating activities actually gave us 100,000, which can add more to the worries. You are telling me we are left with 10,000, but 500,000, and you're telling me again the operating activities we made 100,000. You should be telling me that we have something like 600,000 or so. So we are told the operating activities managed to yield 100,000. Then what about the investing activities? So for the investing activities, we can be told we sold an asset which was now outdated for 20,000, and we bought another one, which resulted in an outflow. We bought another one for 450,000. So overall, there was an outflow of 430. Then we are also told financing activities. We are also told for financing activities, so for financing activities, then you're told we made a repayment of a loan. For financing activities, we made a repayment of a loan. So how much did we repay? We made a repayment of a loan for 160,000. So then we net it off. So overall, it means during the period, overall, what happened? So during the period, we used 490,000. We received 100, we paid 430, we paid 160. So overall, we used up 490,000. So we started with 500. If we remove the 490, then we are left with the 10,000. Now we have justified why now we're being told we are left with 10,000 after there's been an investment of 500,000. But we might again need to analyze this further to say, okay, you are saying the operating activities, they brought 100,000. What exactly was it that brought the 100,000? So we can sub-analyze the profit from operations. So to sub-analyze these profits, we then need to come up with the cash flow statement. So the cash flow statement will help us sub-analyze this cash flow. So the cash flow statement will help sub-analyze these cash flows. So if we want to break down the cash flow from operations, if you want to break down the cash flow from operations, you start with, the assumption is the cash flow from operations, this is the cash flow from the day-to-day activities of the business. And the key assumption is we are not selling goods on credit basis. What we are selling it on cash basis. So if we have profit, that's cash. The profit that we have, it's cash. So we start with the operating profit for the year. Remember, the operating profit is the profit before tax and interest. What happened here? So start with the profit for the year. So for the profit for the year, I'll just put random figures here. Let's say 89,000 is the profit. But this profit consists of expenses which are non-cash in nature, and also their incomes which are non-cash in nature. For example, part of the expenses the company can calculate comprise of depreciation. So we're starting with the profit for the year. Then for all the expenses we have removed that have reduced the profit, which are non-cash item, we add them back. So we add back the expenses we have removed, because if we are saying now we have 89,000 and I ask you, what have you used the money for? Then you say part of the payment I've used to pay depreciation. I will say, can you add that back? Because we don't pay money for depreciation. So we add depreciation. Maybe the other expense we had removed was amortization. Depreciation and amortization, we add them back. The difference is depreciation, that's for tangible assets. Amortization is for intangible assets, but you add them back. Why? Because these ones are non-cash. Just a moment, I need to just have a glass of water. So we add back depreciation. Same goes with if there was amortization. Those are expenses of non-cash item. Also, if maybe there is provision for increase in provision, let's say increase in provision for doubtful debts. Again, that's a non-cash expense. You add those back. So you add them back. Why? Because they are not cash items. Or let's call it allowance, increase in allowance. For receivables. So you are adding that back because you had deducted this as an expense, but it's not a cash item. Then besides the increase, we also have other items we might have added to profit, which are also non-cash in nature, such as if there is a profit on disposal. A loss on disposal, we add it back, but we less if there is a profit on disposal. If you sell an asset and they say to be a profit on disposal, that's an imaginary profit. It's not cash that has been received by the business. So you can't add it to the profit because it's not money that we have received. If we are dealing with cash flows, we are tracing the movement of money. So if I ask you how much do we have, it's 8.9. Then I ask you, how did we get to 8.9? You tell me we have removed depreciation. I will say add back that money. We have removed allowance, add back that money. Because we don't pay money for those expenses. It's an expense, yes, but it does not result in outflow of money. Then besides the profit on disposal, we can also have even the decrease in allowance. It's an income, but it's not money that's coming to us. So for all the incomes, I'm not going to list all of them here, but if it's a non-cash, if the income is a non-cash income, you are supposed to less it, because in the profit and loss, you would have added it. So we less because we have added it, but no money was received. Then for the expenses where no money was suffered, we add it back. Then also their working capital changes. So the assumption is that if in the business, stock, maybe let me start from the stock of the business is meant to bring profit. If you buy something, let's say you buy something for $20, you sell it for $30, you are said to have made a profit. So if the stock in the business has reduced, the assumption is we received more money because we were selling the stock, people were buying the goods, and they gave us money. So that's an operating activity. As we are operating, we sold stock, people bought the goods, and they gave us money. So we look at the working capital changes. If the working capital changes, or if stock, let's start with inventory. If inventory, let's say, has reduced, you can say decline in inventory. This is assumed that money has been received because we sold more goods. If you had inventory of 10,000, now it's of 6,000. It means you have sold goods worth you have sold 4,000 units. So to us, for the cash flow purposes, it's money we have received. So the decline in inventory is actually a cash inflow. So you look at by how much has the inventory reduced. So that is going to be your cash inflow. Then besides the decline in inventory, the other working capital item is receivables. So for receivables, these are the people owing us money. So if they are owing us money, the assumption is if you are being owed money, we are being owed, let's say 20,000. Now we are being owed 5,000. It means these people have paid. So when the receivables reduce, again, it's money that's coming in the business. The opposite is true. If these increase, it means it's money going out. So decline in receivables, it's money coming in the business. Because those that were owing us, they have actually paid. That's why the balance is now less. So if the receivables reduce, it's money coming into the business. Then besides the decline in receivables, we also have a case where another item of the working capital changes is the payables. So again, the payables, if the payables are to reduce, the payables are the suppliers that you're owing. If they reduce this time around, it's not you getting money. If there's a decline in payables, it means you have actually paid. So if those that you're owing have reduced, it's a payment you have made and it's money going out of the business. So the decline in payables, it's actually a cash outflow for you. It's money going out of the business. So after you have adjusted for this will give you now the cash flow from operations. So this will give you the cash flow from operations. So this will give you the cash flow from operations. So that's our cash flow from operations. But we need to remove from that cash flow from operations, you need to remove the interest and the tax that you paid so that you get your net cash flow from operations. So from that cash flow, you remove the interest or finance cost, interest paid. So the interest paid or the finance cost for the year. Remove the interest paid or the finance cost. So you're removing the interest. Let's just give it 3.1. We then also remove the taxation paid. So from that amount, you remove the interest, you remove the tax. So what you then get is the net cash flow from operations. You then get your net cash flow from operations. So the amount here is our net cash flow from operations. So we get our net cash flow from operations. Then, so this is giving us, we are tracking how the cash from operations has been derived. So we started with the amount we received from the profit for the year. We adjusted for the non-cash items. And after that, we also incorporated the working capital changes. Then, after the cash flow from operations, we then move to the cash flow from investing activities. So the cash flow from investing activities, if you're looking at investments, this is money that we have received or paid through the acquisition of assets. So this from here going down is easy because if it's money we have received, it's an inflow. If it's money we have paid, it's an outflow. So for the cash flow from investing activities, we can start with the purchase of non-current assets. If we acquire non-current assets, it's going to result in a cash outflow. If we buy non-current assets, that's cash outflow. Let's assume 21,000 there. Then we dispose PPE, disposal of PPE. Disposal of PPE. If we are to dispose of PPE, it's money coming in. Disposal of PPE, we can have our dividends received. We received dividends from investments, 3,000. We can also have investment in associate. If we bought shares in an associate, the cost of buying the shares. Then you add that up from the top. Then from that investment, now the investing activities, we have combined them. So the 75.7 is not only for investing activities, but it's combining the cash flow from operations and the cash flow from investing activities. Now, let's move on financing activities. We are going to further break down some of this. So financing activities. So the financing activities. So we can have money that we received from issue of shares. So we sold shares and we received money. So issue of shares, we have to take note, is this, are these shares an ordinary issue or a bonus issue? Because if it's a bonus issue, it does not increase the amount of money we have. So the issue of shares, we want to calculate how much did we receive from the issuing of shares. So the amount of money we received from the issue of shares, that's what we are putting here. Then, besides the issue of shares, the company can repay, repayment of loans, repayment of loans, repayment of loans, can pay ordinary dividend. Ordinary dividend paid. Ordinary dividend paid. So we can also have the effect on the share premium. So if we issue shares, these can also result in an increase in our premium. So the other issues will depend on the question we are dealing with, but I'm just putting the general issues here. Then we say 75.7, you add that, you add that, add that, add that. Now, this is the net cash flow for the year. So this amount here is the net cash movement for the year. So this is the net cash movement for the year. We then add the opening cash and cash equivalents. So you add your opening cash and cash equivalents, which could be, let's say, 16,000. Then we get the closing cash and cash equivalent. Now, let's break this down further again. So in some cases, in most cases rather, you will not be given the depreciation on the platter. You have to work out the depreciation. So if the depreciation is not given, there is need for you to be able to open the asset account to work out the depreciation. So if the depreciation is not given, it's assumed you know how to open the asset account, its net book value, or the provision for depreciation account. If the depreciation is not given, it can be calculated using the asset account at net book value, or the asset account at net book value, or the provision for depreciation account. So if you're not given the depreciation, you can use those two accounts to figure out the amount for depreciation, depending on the question. You look at the question, you see from the information given, what is it that I can be able to calculate? So besides depreciation, again, we have the profit or loss on disposal. That one, if the profit or loss on disposal is not given, so profit or loss on disposal is calculated using the disposal account. The profit or loss on disposal, you need to open the disposal account. So the disposal account is what will help you to figure out whether there is a profit or there is a loss on disposal. So in most cases, you might not be given again the profit or loss on disposal. So it's up to you to figure out from the information that you're given, how can I come up with the profit or loss on disposal? So the disposal account, remember, you just need for the disposal account, so for the disposal account, you need the cost of the PPE. You need the cost of the PPE. The cost of the PPE, then this side we have depreciation. The depreciation of the PPE. The depreciation of the PPE, 12,000, just putting random figures. Then the price we sold the asset at, the price we sold the asset at, it's the price we sold the asset at, we can say 25,000. So in some cases, you might not see it as a T account. So they can provide the answer in column form. So for here, we then determine which side is the bigger side. So I think it's this side. So if the difference is this side, there is a loss on disposal. So you can still use this T account format, or you can use the column form. That is if you're familiar with it. So for the column, they can start with, they can give you the answer in this format. They can say maybe the cost of the PP, or they can, let's say, they can say the depreciation, $12,000. Then the bank is 25,000. Then they say cost of the PPE is negative 43. So it means the balancing figure here, if it's a negative, it's a loss. Positive, it's a profit. So there's a loss on disposal. So Either way, it's still fine as long as you manage to get the correct answer. So after the depreciation, the disposal, you also need to be able to, you must be familiar with how you work out the finance cost. So the finance cost, you open the finance cost account. So the finance cost is likely to be given with opening and closing balance. So the finance cost is opening balance on the credit side. This is the same for dividends. So finance cost and dividends. The account is going to be the same. So you start with the amount this side, the balance BD. So that's the amount being owed at the start of the period. So we are saying you get this in the balance sheet on the current liabilities section. So they can tell you that there is an interest owing, or they'll actually give you the finance cost under liabilities. So that is the opening balance. Let's say on our liabilities, we had 17,000 as a finance cost. Then the finance cost for the year, which we take to the profit and loss. Or the dividend for the year. So the finance cost for that year is what we put here. So the finance cost for that year is what we put here. Then the balance CD will be given in the liability section. The balance CD will be provided. So the balance CD could be, let's just say 21,000. So the balancing figure is your finance cost paid. So you won't be given the finance cost paid. So the balancing figure is the amount for the finance cost paid. So the finance cost paid. The finance cost paid it will be 26,000. Finance cost paid, it will be 26,000. Now let's move on. Besides the finance cost, we also have tax. So the issue with tax, we might have deferred tax. So for tax, we might have deferred tax. So again, it is balance BD this side. So the balance BD for the tax, you add the current and the non-current liability. So you are adding the current year liability and the deferred tax. So you're adding the current plus the non-current. So there will be tax as current liability and tax as non-current. So you add the two, the one in the current and the one in the non-current liability. So the non-current liability will be given as deferred tax in most cases. So you're adding that. So we are saying, let's say a case where the current liability tax there is 2,000, but the deferred tax is 23,000. You add that. Then the amount of tax in the profit and loss or income statement put here. One in the income statement. Then again, the closing balance you add the current plus deferred at the end of the year. So we're saying, let's say 12,000 plus 16,000. So we then add up that. So that would be the tax paid. That would be the tax paid. That would be the tax paid. Then let's go down with it. So after the tax paid, we go to the investing activities. So for the investing activities, the purchase of non-current assets is the issue of just knowing how much did we buy the assets for. So we just need the price we paid to acquire the non-current asset. The same goes with the disposed asset. What we are more concerned with, the price we charge. The price we charged for the asset. So these you can get them using the assets account. Just a moment. Okay, so that's the purchase of non-current assets. Then let's move on. We have dividends received. Dividend received, it can differ. In some cases, some can put it under, depending on the policy of the company, some can put it under operating activity, but or others policies can put it under investing activity. Then let's move on. Investment in associate. What we are more concerned about is the price we paid to acquire the associate. So what we paid to acquire the associate is again the investing activity, the cost of the associate. Then for the financing activities, I'm just thinking there is the right of use asset. We have not talked about that one. We have not included that. So remember, the asset could be a leased asset. So if we are leasing the asset, the lease payments are part of the financing activities. If the asset is being leased, if the asset is being leased, then the payments that you're going to be making are relating to this leased asset. That is treated as a finance cost. So you can say if the asset is being leased, the lease payments are recorded as a financing activity. If the asset is being leased, the lease payments are recorded as financing activity. Let's check so investing activities. After investing activities, issue of shares. So for the issue of shares, I think what you just need to watch out for is if the shares are issued, the bonus issue does not increase or reduce money. So it's a non-cash item. So in terms of cash flow movement, it does not have an effect on the cash flow movement. So this is assumed we've done this in F3. So some of the things I don't need to go into detail. Unless if you can go through the questions, then where you have issues, we then deal with those particular issues because of time. So for the issue of shares, you need to consider, is it a bonus issue or an ordinary issue? So if the shares have increased because of an ordinary issue, it means you have received money. If it's a bonus issue, then there is no cash movement. So we're not going to be increasing our reserves because of a bonus issue. A repayment of a loan, that's general. Ordinary dividend. So if it's not given, you need also to open the account. But this is the same account with the finance cost. So for the dividend, it's normally, for the dividend, we can actually use to determine the dividend paid. The dividend paid, we can use the retained earnings. We can use the retained earnings. So if we are given the retained earnings at the start of the period and the retained earnings at the end, so we are saying for the closing retained earnings, so for the closing retained earnings, because the dividends in the statement of changes in equity, the dividend paid is removed under the profit column. So say the closing retained earnings, you then less the opening so less the opening retained earnings. Let's say the opening were 23. This will give us the retained earnings this will give us the profit which was made during that year. We then less the profit trying to, let's use so in the statement of changes in equity, we say the opening retained earnings. We say the opening retained earnings. Let's say if it's 24,000. Then after the opening retained earnings, you add the profit for the year. Add the profit for the year. Let's say the profit for the year is 34,000. Then less the dividend paid. You then get the closing retained earnings. Was the dividend paid it reduces the retained earnings. So if you have the opening retained earnings, the profit for the year, and the closing retained earnings, we can work out the dividend paid. So that could be, let me just say 24 plus 34. Then maybe we are told there is 55,000 for closing retained earnings. So the dividend paid would then be the balancing figure. So we started with 24, we added 34, and we subtracted the dividend paid, but we now remain with 55. So that's why I was trying to do it in reverse. So we're saying you can say this minus that, because we're adding that, so we are supposed to subtract, yes. So the dividend paid becomes the 3,000. So you can actually use the retained earnings. That's using the statement of changes in equity format to work out the dividend paid. That's the ordinary dividend paid. So that's regarding the dividend paid. So most of the stuff is just the same with what you did in financial accounting. So that we don't delay a lot on this, I would want you to go and practice questions so that you figure out where there could be issues. So now I want us to add one more standard so that at least we can cover another standard today. So I want us to look at, let me just check the list of standards that we've covered. So I think we can look at fair value measurement. So that's cash flow statement. Cash flow statement. So the next standard is, let's look at, let's just start with IAS 8 and IAS 10. Those are very short standards so that we just clear them out. So let's just look at IAS 8 and IAS 10 and clear those standards so that at least for this one, there isn't much. We have talked about that. So going to practice this so that in case there are gray areas, you can then come back and we look at those. So now let's get to IAS 8 and IAS 10. I'm sure we can complete these two in the remaining time. Okay, so IAS 8. So IAS 8 is a standard which deals with changes in accounting policy and estimates. So the standard deals with how do we account for the change in policy and change in estimate. So if a business is said to have made an accounting or has made a change in an accounting policy, what is it about? Then what is a change in an accounting estimate? So let's have that down. So let's start with what an accounting policy is. So let's start with what we can call an accounting policy. So an accounting policy are the principles or rules applied by the entity. The principles or rules applied by the entity in preparing and presenting the financial statements. So when we are preparing the financial statements, there are rules that we are going to be following. There are rules that we are going to be using as an organization, or we can say maybe we are using the local standards. We decide to now adopt the international accounting standards. So that's a change in the policy. We have changed the rules we have been applying. So the rules we are using in recording transactions, those are policies. Then what about estimates? An accounting estimate is an approximation of the amount in most cases is the amount of the liability, or an estimation of the amount of a business transaction for which there is no definite amount. So we are estimating, we are not sure the provision for bad debts, for example. We are estimating those that are likely to default. So if we adjust that estimate, we say there's a change in an accounting estimate. So if we say we were using a different standard, now we have changed, we are applying a different standard. That's a change in the rule, not an estimate. So if there's been a change in the rule that we have been applying, or if there's been a change in the accounting policy, we are supposed to make what you call a retrospective adjustment. So if there is a change in the accounting policy, the organization is required to make a retrospective adjustment. So a retrospective adjustment, it means we adjust even the prior year financial statements. We don't just start adjusting from this year, but you go back to the previous year financial statements and you make adjustments. So this means that, remember, the financial statements for the other years will be stored. The financial statements are kept for a period of about 6 years. So it means you go back to the prior financial statements and you make an adjustment to the amount so that they can be comparable, so that the amount, the financial statements can be in a comparable format. So this means that we adjust the current financial statements and the prior year financial statements. So that they can be comparable. So you're adjusting the current year financial statements and the prior year financial statements. Then besides IAS 8, where you're making changes to the prior financial statements, we also have IAS, sorry, not IAS, we also have a change in estimate. So if there is a change in accounting estimate, the business must make a prospective adjustment. So a prospective adjustment, we are changing from this year going forward. We don't adjust the price. So we change from that year going forward. That is if it's a prospective adjustment. So I think that's just about the standards. It's just for you to know that if the company is said to have made a change in the, I'm sure the change in estimate, we have been dealing with this often. So in most cases, you know that if we change maybe estimate for depreciation, sorry, estimate for bad debts, we just change from that year going on. But if you come across a question where maybe you are told that they have changed, this is likely to be a multiple choice though. But if you come across a question where they have said there's a change in policy, you don't, maybe the change in policy has resulted in the profit. Maybe we can say the opening retained earnings. Can you have the retained earnings? So we have 2005 and 2006. So 13,000, 14,000. During the year, the company changed its depreciation policy which resulted in the increase in the depreciation charge by 1,200. So they've changed the policy they were using. Now the new charge is now higher than the previous one. So it is very comparative. It means the opening balance here, if the depreciation is now higher, it means the last year depreciation was understated. So it means we have to adjust the prior year amount because they've said it's the policy that has changed. So if there's been a change in the policy, we adjust the opening balance. So that they can be comparable, you adjust the opening balance. So that's just with IASA. If the change is a change in policy, you need to adjust the prior financial statement. Then let's move on. Besides IAS 8, we have IAS 10. These aren't new standards. These are also part of some of the standards which are there in F3. Like IAS 10, these are events after the reporting period. Events after the reporting period. Events after the reporting period. So for the events that are occurring after the reporting period, there are events that we say are adjusting events, and certain events we say they are non-adjusting events. So the events after the reporting period are the events occurring after the financial statements have been prepared. But before they have been signed by the auditors. So the financial statements are going to be prepared, then they are handed over to the auditors to verify these accounts. After the accounts have been verified by the auditors, then they are then sent to the shareholders. So during that period, after the accounts have been prepared, they have not yet been verified by the auditors. They are not yet done being verified by the auditors. We can come across certain issues. Some issues can come to our attention. So these issues can either fall in the bracket of adjusting events, or they can be issues falling in the bracket of non-adjusting events. So if an event is said to be an adjusting event, these are events showing evidence that they existed at the financial statement date. So these events are showing that when we prepared the financial statements, they were existing. These events were present when the financial statements were prepared. So they were present at the financial statement date. These are adjusting events. They are showing evidence that they existed at the financial statement date. Then the non-adjusting events. These are events after the reporting period which do not need an adjustment to the prior financial statement. So from this, I think we can actually put number one of our adjusting event as being a change in, we can put a change in accounting policy, because we've said if we change the policy, we have to adjust the prior financial statement. So you can say change in policy, or let's say adjusting events, those that require the adjustment of the prior financial statements. So if there's a change in the policy, and what else? So in the financial statements, we had recorded someone as a debtor or a receivable, but this person became bankrupt shortly after the year end. What are we supposed to be doing? We're supposed to create an estimate of those that are likely to default, and we remove them from receivables. So we create an allowance for receivables and we remove it from the receivables figure. So it means you had under-created the allowance. So debtors falling, so you can say irrecoverable debts after the financial year. After the financial year. So they're irrecoverable debts shortly after the financial year. So it means you had overstated your receivables. You're supposed to have adjusted for these receivables. Then you can also have inventory being sold at a price, inventory sold. These are some of the questions that can just come as multiple choice. So inventory sold at price below cost. So remember, inventory should be valued at the low of cost and net realizable value. So it means you had overvalued your inventory. You had not recorded at the lower, because if you had recorded at the lower of cost, how did you end up selling at a price below cost? So it means you had overvalued your inventory. So that's another issue of concern, inventory being sold at a price below cost. Then also another issue, discovery of error and fraud. So discovery of error and fraud after the financial statement date. So those are adjusting events. Then the non-adjusting, it means everything else then falls under the non-adjusting events. But there are non-adjusting events that have a significant impact, such as natural disasters after the year end. So the building was destroyed. So there is a non-adjusting event, but with a significant impact. So how should we deal with a non-adjusting event with a significant impact? So non-adjusting events with a significant impact must be disclosed. You don't adjust, but you simply disclose in the notes to the accounts. So you just make the disclosure in the notes to the accounts. So especially if they are not, those events that are significant. So they must be significant. So them being significant, it means they are affecting the nature of the business or the performance of the business, or it could be the going concern of the business, such as the warehouse being destroyed. Not because we can have a case like we have just lost, maybe we just close to one, if thieves broke into the warehouse and they store, out of 1,000 bags that we have, they store 2 bags. It's something that occurred after the end, but it's not significant. We can't say now we have to make an adjustment for that or disclosure for that. So if it's an event that's not having much significance, you can just report it at the end of the year. Then if it is an event that is significant, then there's need for an adjustment. Then that's it with IAS 10. It's just a matter of you being able to figure out, is this one requiring an adjustment? Does this one need no adjustment? So that is IAS 10. So it's not a new standard. So is IAS 8. So is cash flow statements. So there could be just 1 or 2 areas where there may be differences. The structure is still the same. They will just maybe add on the complexity of the question, but it's just the same. So you need to practice so that you get familiar with some of the areas that they can, somehow they can examine you. And also, please, as you practice, especially the likes of Power, and if there isn't also applied skills exams, do make use of Excel so that you familiarize yourself with the use of Excel, because in the exam, it's no longer multiple choice. You have to be preparing the cash flow statement in the exam. You have to be preparing, if it's the income statement, you prepare the income statement using the spreadsheets, this Excel. So it's wise as you practice, just get used to the Excel so that in the exam, your typing skills will be at least at par with what is required, and also so that in the exam, you won't start looking for some things you'll be actually used to where you can find them. Some of the functions which are on this Excel are not there in the exam. So if you make use of the CBE practice platform, it will show you the Excel that you use. So it's not all these functions that will be there, but the general, this percentage, the additions and subtractions, they'll be there. But again, if you're using the CBE practice platform, they will give you the real exam spreadsheet, which mimics the one that you get on the exam day. So get used to that one so that we avoid any surprises. I wouldn't want to introduce any new standard now. So can you go and polish up that which we are discussing? Then in the next, I think, 2 sessions to come, we'll then complete, and we have 2 more sessions for revision. So please start revising now. We don't have much time to revise all the areas. I will just revise the key areas with you, but the rest, it's your stuff. It's you that has to do much of the work. So for today, I think we can end here.